The broadcast is now starting. All attendees are in listen-only mode.
Hi everyone, welcome. We're now ready to begin our webinar, Equity Compensation. Next slide. Corey, next slide, please.
Yeah, okay. It was slow to respond. Sorry.
That's okay. I'm Virginia with Rutgers School of Management and Labor Relations, and I'll be your host and moderator. The Rutgers, New Jersey, New York Center for Employee Ownership is proud to sponsor today's webinar, and we have allotted 45 minutes for this presentation. Next slide. We encourage everyone to send us your questions throughout the webinar. To do so, you will click on the orange arrow, you will type your questions into the question box and press send at any time. We'll actually be taking your questions throughout the webinar. Next slide. The webinar is being recorded and a link to the archive version will be sent to you by email by the end of this week. It's now my pleasure to introduce our instructor. Corey Rosen is the founder and senior staff member of the National Center for Employee Ownership. Over the years, Corey has written, edited, or contributed to dozens of books, articles, and research papers on employee ownership. Corey is generally regarded as a leading expert on employee ownership and has appeared on numerous national radio and television news programs. Corey serves on a number of ESOP company boards in addition to his duties at the NCEO. Corey, please take it away.
Thank you very much. I really appreciate the opportunity, Virginia and Jim, to do this for Rutgers. It's a long-standing relationship between Rutgers and the NCO, and one that's been, I think, great for both of us. So what I'm going to be talking about today is various forms of equity compensation for employees. And it would be really helpful for me to get started if in the questions area or the chat, well, let's do it as a chat, I guess. If you could just put in what your interest is in this. Are you a business person or a professional? That way I'll have a better idea how to aim this presentation. So if people could just put that into the chat area. I'll wait a second here.
You know, Corey, I'm not sure if the chat's available to people. They're actually doing it in the questions. Yeah, so we just received one in the questions box. Are you able to see that, Corey, or do you need me to read it?
No, I can see it, and I'm getting a few showing up here.
Good, good.
I'm going to wait just a moment for others of you to put something in. So far, only about half of you have, so the rest of you could do this. That would be really great. Looks like we've got a mix of professionals and companies, so we'll aim it at both of you. All right, so the first issue that companies have to decide in equity compensation is who should get it. Should it go just to a few key people? Should it go to a broader swath of people? Should it go to everybody? There's this quote-unquote rule, the 80-20 rule, that says that most of your performance comes from a few key people, and they need to get and deserve to get most or all of the rewards. If you read compensation consulting publications, they all seem to think that this rule is somehow written in stone and is just obviously true. But if you look at the actual empirical research on this, it turns out to be a total myth. In fact, the 80-20 rule had nothing to do with any of this. It was created in the early 20th century to describe land ownership patterns in Italy And in the 1930s, an organizational development consultant in Britain named John Duran said, well, I'll bet that applies to organizations too. And so he just proclaimed that this rule must be true. And I think in part because it fit the concept that the people who already were making these decisions about equity in companies had, or other sorts of incentives. They said, well, that must make sense. The most valuable people probably are us. But the research actually shows that organizational performance is highest in high engagement companies where everyone is contributing ideas and information, and that broad-based incentive and broad-based equity plans are certainly part of that incentive structure, encourage that kind of engagement, whereas highly concentrated ownership actually decreases performance. So the 80-20 rule turns out to be just wrong. And I'm sorry, I'm having a little difficulty with the screen not going to the next slide. There we go. So why does ownership culture matter? There are multiple studies that show that companies that have what we call ownership culture, which is a combination of open book management and high engagement work practices, perform far better than conventionally run companies. In fact, the largest study ever, which was done by 2 professors at Rutgers and 1 at Harvard, showed that if you look at the applicants for the best 100 companies to work for over a 5-year period, there's 736 companies and 330,000 employee surveys. Companies that combine sharing the rewards of capitalism with high engagement management styles perform substantially better than those that did not. And it's not because people are making more effort so much as that people are contributing more ideas, more information, they're identifying more problems, and they are getting rewarded as if they are acting like owners. So if it's true then that what you really want to get is a culture of ownership, do we need to bother with actually sharing equity with people? You often will read that what people need at work is a sense of ownership. Now it's noon. Some of you may be eating at your desk or thinking of going to lunch later. So I'd like to suggest that we all go to lunch and you can soak up the atmosphere. We'll go to a really nice place. You can soak up the atmosphere, help make decisions about what to eat. In fact, you can even help pay for it, but you're not actually going to get lunch. You're just going to get a sense of lunch, and that should suffice. Well, probably not. And the sense of ownership works about as well. So if you're going to decide to share equity, the first decision is who to share it with. And my argument has been that it's better to share it broadly than it is to share it narrowly. But much of what we're going to discuss today will apply whether you're giving it to one person or to everyone. So the second bullet point on this says deciding who will get how much with what terms. And here we have to look at such things as the allocation of equity per employee, vesting rules, and rules about how the sale of stock occurs. Or if it's synthetic equity, how you pay for the value that those awards deliver. And finally, you have to choose the form or forms of equity that you're going to give out. There are a number of different approaches to sharing equity. The most common, and when I talk to companies about this, is I say, well, how much equity are you thinking of sharing? And they say 10%. And I say, why 10%? Well, that's what we've heard other people do. You can see how this quickly becomes a self-fulfilling prophecy. Because if what you've heard is that other people do it, then it makes sense for you to think about doing that as well. But 10% of one company is not 10% of another company. So the value of 10% of Google would be far different than the value of a startup internet search company. So you're giving away very different amounts with that same 10%. A second approach is an individual percentage based on surveys. And often in surveys, especially in the tech sector, what the survey says is what percentage of the equity goes to the chief operating officer or the chief IT officer or whatever. And that really gets you back to this 10% problem, because you're basing the value on the percentage of the company. You're just slicing it up in pieces now. A dynamic model looks at this differently and says, let's create an amount of equity each year that we can give out, or 2 years or 3 years or whatever number you're comfortable with, based on performance. So if we reach a certain target, whatever critical numbers we've decided the company has, if we reach that target, we'll give away a percentage of the added value that we create by reaching that target as an equity pool. So if our target's $1 million in profit and we get $1.2 million, we might say, let's take 25% of that extra $200,000 and we'll make that available as an equity pool this year. I like this approach, and most of the business people I've talked to when we talk about it end up doing this because it's flexible, because it gives people an opportunity to earn more equity every year. It gets them to focus on what matters. And if you don't perform well, you don't have to share equity. The percentage of the company you ultimately give away is less important to an owner than the value that's ultimately created. And if you have questions, by the way, just type them into the question area. I will check those periodically. So we've looked at the fixed percentage. We've looked at percentage of compensation. One problem with the compensation-based approach is that it doesn't accommodate growth easily. So let's say you hire, in your early years, you have 10 people, and you give out equity based on percentage of compensation, percentage of the value of the company to 3 of them. And that's your CFO, let's say your COO, and your chief IT officer. And then you grow the next year, maybe faster than expected. And now you need new people, and you need people at high levels. But you've already given away a fair amount of equity to the first 3 people. So what do you do with the rest of these people? And the dynamic model, we've talked about that it focuses on sharing value rather than percentages, and it changes entitlements to incentives. On the other hand, the negative is that people are less certain about what they might actually get one day. So deciding who gets how much, this is the next step. This first step we had was decide what percentage of the company to give away or to share. The second step is to decide, well, now we've got that pool, how do we decide who's going to get it? We break up this pool to allocate it amongst the individuals. So one way is to use surveys. And that sounds really appealing because, after all, what you're trying to do for many companies with equity compensation is compete in the labor market. The difficulty with this is that it's hard to find truly comparable companies participating in these surveys, and their compensation philosophy and yours may be very different. A second approach is percentage of compensation. Now, the argument here is you've already decided that people are worth a certain amount of pay per year, so why shouldn't their incentives follow this? Because presumably your pay decision is market-based and based on your assessment of their contribution to the company, but if you do this, it may not work if, for instance, you're hiring some people at less than market pay with the idea that you'll make it up with incentives. And it may not recognize special roles or abilities that certain people have. Merit assessments can be great if you can figure out a way that people buy into and think is really not political. That can be difficult to do. And finally, egalitarian, where everybody gets the same, top performers may see this as unfair. So there's no obviously right way. You've got to decide what philosophy fits. And we'll look at the rules that you can have for these awards. If you're familiar with the rules for retirement plans, you know the term vesting. Vesting in a retirement plan is different from vesting for individual equity awards, in that in a retirement plan, let's say that you have a contribution from your company to your retirement plan and you are 20% vested after the second year, 40% after the second, and so on. Each additional contribution the company makes the next year, you are vested in whatever that is at the same vesting percentage you were for everything else. So if you're 40% vested after 2 years, you're 40% vested in the entire contributions that have been made by the company over that period. But with individual equity awards, each award has its own vesting schedule. So if I get an award in 2018 that has 3-year vesting, that award will vest in 2021. In 2019, if I get another award with 3-year vesting, that award won't vest till 2022. So each award has its own vesting schedule. One of the issues with vesting is if you have a year that triggers it, then employees may have a tax event once those awards are vested, as we'll discuss later. If you decide, no, we'll only vest once we have a liquidity event, employees may see this as too far off and too uncertain to really be worthwhile. A second issue with vesting is, will employees be able to exercise their award prior to a liquidity event? So if, let's say, I have some sort of equity award and I'm fully vested, that means I have a right to that award, but you also have to give them the right to exercise that award. In other words, to essentially take possession of it. But if I take possession, for instance, of a share and it's not liquid, I'm going to have to pay taxes on it. That could be more punishment than reward. And finally, can employees sell the shares once fully vested to anyone, or will the company have the right of first refusal? So these are all decisions that you need to make. Okay. Again, ask questions when you have them. So now we're going to look at choosing an award. And we're going to look at stock options, restricted stock, phantom stock, stock appreciation rights, and other approaches. So now we're going to get into more technical issues. Stock options are the right to buy shares at a price fixed today for a defined number of years into the future. So I'm given the right to buy 100 shares of, let's say, well, it wouldn't be Google, it's $1,000 a share. Let's say 100 shares of Facebook. And I have the right to buy them at whatever their current market price is. Let's say that's $50. I don't know what it is, but let's say it's $50. And I can buy shares at $50 for the next X number of years. And typically that's going to be 5 to 10 years. You have the right to decide what that number is. So let's say I have a 7-year period in which to exercise. That's called the term of the award. And at the end of 7 years, they're $80. So now I can buy $80 stock for $50. If the stock price goes down, I just don't exercise. Options can be granted on a discretionary basis, and different kinds of options have different kinds of treatment. So there's two different kinds of options, incentive options and non-qualified options. Incentive options provide a capital gains treatment, and NSOs don't. So when you exercise a non-qualified stock option, so in our example, we exercised at 50 to buy an $80 stock, that $30 is taxed as ordinary income. It's taxed in exactly the same way that wages are taxed. And that's true whether you sell the shares or not. So once you take possession of the shares at exercise, that is a taxable event. And the money that you use to purchase the shares is after-tax money. By contrast, if you get an incentive stock option and you've held that option for at least 1 year after grant and 2 years, 2 years after grant and 1 year after exercise, you don't have to pay tax at the time that you exercise the award. Instead, you can wait until you actually sell the stock. And if you sell the stock and consistently with these rules below, then you can get capital gains treatment on that $30 increase. You still have to come up with the after-tax money to purchase the shares, but you don't have to pay tax until you sell, and you get capital gains treatment when you do. So that can be very appealing. The spread, though, in a non-qualified option is deductible to the company, and it is not deductible in an incentive option. ISO rules do have some limits. They have to be granted at fair market value. Certain shareholders cannot receive grants unless they're at 110% of fair market value. Not more than $100,000 can first become exercisable in any 1 year. That's for each grant, and the $100,000 is measured as of the grant date, not the exercise date. The term can't be more than 10 years, and only employees can hold ISOs. Anybody can get an NSO. You can give them to your contractors, your board members, your advisors, anybody. But only employees can hold ISOs. And after they leave the company, they automatically convert to non-qualified options if they're not exercised within 90 days of termination. The spread on an ISO is also subject to the AMT. Many, if not most, ISO recipients at higher income levels still will be subject to the AMT, although the tax law in 2017 increased the number so that the dollar amount where you have to start paying AMT. But still, for a lot of the very successful people who get ISOs, who tend to be higher paid employees, they're often going to be subject to that. Okay, so we have a question: would the dynamic model not be dilutive? Anytime you're giving out equity, it's dilutive, right? By definition, if you're giving away equity as part of compensation, it's dilutive. Now, of course, I once wrote an article on equity compensation called Dilution or Delusion, and it was talking about strategies for decreasing the apparent number of shares that employees got by giving them restricted stock instead of stock options. So if I actually give you a share, it's less dilutive than if I give you options in terms of the way these things get measured in public companies. But if I'm giving you the same dollar value ultimately, if that's the goal, then what difference does it make ultimately in terms of the value of the company, whether we're diluting the share value or we're diluting the financial value of the company? So every model for giving out equity dilutes ownership, but the deal you're making as an owner in giving this out is that by sharing ownership with employees, the company will get bigger. So yeah, you will have a smaller percentage of the company, but the company will be bigger. You have a smaller piece of a bigger pie. The dynamic model changes the dilution in that it tries to say we're only going to dilute equity if the value of the company is going up and we have extra value to give away. Whereas a fixed percentage grant says we're going to dilute equity at this level, 10% or whatever, no matter what. Second question, is granting equity in companies as effective as incentivizing methods of sharing performance that require payroll deduction or some type of financial risk for participants? This is the skin in the game question. Do employees actually become more engaged if they've had to put up their own money? There isn't any research to suggest that that is true, that in fact, if you're asking employees to put up their own money, it's a lot riskier. Their expectations are going to be a lot higher than they would be. If the company doesn't do as well as they expect, then you could have a real demotivating effect. So asking employees to put up their own money, I think, is a pretty risky strategy. If you want to be a bit Machiavellian about it, you could say, well, I'd be willing to pay people $75,000, which is a little more than what the market asks, but then they'll have the opportunity to take some of that money and buy shares in the company. Or I could pay them $70,000 and I could give them $5,000 in equity. Well, all the research says that the second model is better because people value losses, the $5,000 they had to pay, much more than they value gains. So the pain of putting up that $5,000 is much less than getting $70,000 and you never saw the $5,000 to begin with, and getting $5,000 added. So I would go with the grant approach. Okay, and non-qualified options again can be transferred to anyone with any terms the company chooses. They can be transferred, but whoever they get transferred to has to pay the tax. So let me just pause one question. Any questions about stock options before we go on to restricted stock? I'll give you a second here to think about that. All right, I don't see any, but feel free to ask as they occur to you. So restricted stock is the right to buy or be granted actual shares. With options, what we're getting is the right to the increase in the value of a stated number of shares. With restricted stock, we're actually getting the stock at its full value. So restricted stock can be either, I'm going to give you the right to buy X number of shares, or I'm just going to give you the number of shares. Now, what restricted means is I'm going to do this, but, and the but is that there are going to be certain rules, mainly vesting rules, that have to be met in order for that restriction to be lifted and the award to be truly yours. So the restrictions typically are vesting, but they could also be meeting a performance target or a combination of the two. The vesting is usually seniority based, that is, each year you get more vesting, or it's cliff vesting. And they're taxed as ordinary income when the restrictions lapse or an 83B election is made. I'm going to talk about that. So very few restricted stock awards are purchased. They're typically granted to the employee. So let's go back to our $50 a share example, and let's say we got a restricted stock grant for $150 shares or $5,000. Now, because there is a restriction on that that says it's not really mine until they become fully vested, and let's say we have a 3-year cliff vesting, so they're not really mine for 3 years. The law says because you don't certainly have this benefit, you don't have to pay tax on it now. You only have to pay tax when you have an unrestricted right to a benefit. But you might say, you know what? What I'd like to do is pay tax on the $5,000 now, because if I do that, I don't have to pay any more tax until I actually sell the shares, and whatever increase in value from $5,000 to where I sell it is going to be treated as capital gains. So I'm going to make this election, because if I don't make this election, when those awards vest 3 years from now, let's say they're not worth $50,000 or $5,000 now, but $8,000, I have to pay ordinary income tax on $8,000, whether I sell the shares or not. So rather than pay that potentially higher income tax and not maybe even have a liquid share, I'll take my chances and pay the tax now. Well, what happens if I never vest? I get fired or the stock price goes below $50. Can I go back to the IRS and say, you know, I paid this money and it didn't work out. Can I get my taxes back? The answer is no. You took a gamble and you lost. So that's a risk that people have to take. We've done an analysis on how meaningful the capital gains tax benefit is to people under the new tax law. And because of the way it lowered marginal income tax rates, you have to be a pretty high-level income employee for capital gains to be a big deal. And maybe under $100,000, it's going to be a very small deal indeed. So for those employees, making the 83B election is almost certainly not a wise decision. There were some changes in the 2017 tax law, and basically this is aimed at employees who leave the company with stock that's not liquid. It's a private company, and they don't have the ability, or maybe they don't want, to sell the stock back to the company if the company indeed buys the shares back. And so Congress said, well, you can wait for up to 5 years after you leave. I'm not going to go into these here. If you have questions, I'd be happy to answer it. The important takeaway from this is it has to be very broad-based, and analysts of this suggest that few, if any, companies are going to want to use it because there's a whole bunch of issues that come up with this that make it less appealing than it seems. So Congress's heart was in the right place, but their head was a little confused. Questions about restricted stock? Don't see any. Restricted stocks become very common, and especially in more established companies where the potential increase in value is not so dramatic as it is in younger companies. And restricted stock has the advantage that if the share price goes down, you still potentially have real value. So this slide, if you're interested, shows why the 2017 tax law that I just described for delaying the taxation from employees in closely held companies probably isn't worth anything. So maybe you don't want to give out shares literally. Instead, what you'd like to do is give out synthetic equity. These are very simple. Phantom stock simply says you have the right to the value of a hypothetical number of shares. Yeah. You have, excuse me, the right to the value of 100 shares at $50. There again are going to be restrictions like performance or vesting. And then once you reach that vesting award time, then it's worth, let's say, $80,000, and the company writes you a check for $80,000, and that's taxed as ordinary income. Stock appreciation rights are the same idea, except that what you're getting is the increase in value. And again, that's taxed as ordinary income. So we see a lot of synthetic equity in closely held companies because it's simpler and because providing people stock in closely held companies with no liquidity may be more punishment than reward unless you really have on the horizon a sale, an investor, or a buyback from the company. Stock settled stock appreciation rights. This is a little more clever variation, but it essentially says here's the right to the increase in value of a hypothetical number of shares, let's say 100 shares. And when you reach vesting, what we're going to do is we're going to pay enough money to you to pay all your taxes, and then we'll give you the remaining net amount in shares. So this is less dilutive than options. It's still going to cost you the same amount of money, but you're ultimately giving away fewer shares than you would with options because they're getting the net of the difference minus taxes in shares, not the total shares. Restricted stock units, that's essentially the same thing as stock settled stock appreciation rights. Here, though, we're talking about the full value of shares. So that's saying that when the restrictions lapse, you fully vest, we're going to give you the shares at the time that they vest, whatever the number of those shares is. There's no 83B election available with restricted stock units. There are complex tax rules here under Section 409A of the tax code. These are meant to prevent the excess deferral of income from equity awards. They're fairly complicated. We can go into those in questions if you're interested, or there's a lot of information on this on our website. The takeaway on this that you need to know is that you can avoid any of these punitive taxes very easily by design features of equity awards that are pretty common for what you'd want to do anyway. So it's not difficult to get around it, but you need to know what they are so you don't get nailed by them. Penalties are really intense. For valuation, you do have to have your awards valued if it's a closely held company. Independent appraisals are the gold standard, but other sorts of formulas may be acceptable. You should work with your advisor to make sure you understand the IRS guidance on this. Limited liability corporations don't have stock. They have membership interests. And you can do pretty much all the things that we just discussed with restricted stock, stock options, phantom stock, and stock appreciation rights. There are parallels to each of those things in LLCs. They're very, very close with just a few wrinkles. LLCs, of course, are very popular. They are pass-through entities, meaning that the corporation doesn't pay tax. It passes through its tax obligation to the owners of the company, or in this case, the members of the LLC. And that's one of the big wrinkles with LLCs in equity compensation, is that if you give someone a profits interest or capital interest, and those are the equivalents of stock options and stock appreciation rights, those employees are not treated as employees anymore. They're treated as partners, and so they're going to get a K-1 statement saying you owe this much money on your taxes based on the profits of the corporation. They're going to need to get distributions of earnings in order to pay those taxes. So it can create some difficulties. They also don't get employee treatment for things like their corporate contribution to health insurance being deductible and Social Security contributions and the like. Lawyers tell us that there are ways to get around that, but you need to be aware that that is something the IRS thinks, and the resolution of this is still a bit uncertain. So the rest of these slides go through profits, interests, and so on. I'm not going to spend a lot of time on those. If you're interested in LLC issues, you can give me a call, or we have a whole book on that. Securities law issues, if there's an offer to sell, that makes it a securities law issue. And so you have to make it compliant with federal and state rules. This is not a difficult thing to do in most cases. There are a number of exemptions that you're going to come under. So not something to worry about, but again, something to know about and make sure you do it right. Let's see if there's more questions. We have a whole webinar that's recorded on employee stock ownership plans. This is a very different way to share ownership. Here, the company sets up a trust to buy and hold shares. The trust uses pre-tax company contributions to fund the plan, and then the trust can borrow money to buy shares even faster. So it's a way to use pre-tax dollars to get corporate liquidity. The sellers can get a capital gains deferral. But unlike the equity compensation strategies we've talked about today, ESOPs have to be inclusive. They're meant to give all full-time employees a share of the allocations in the plan. If you don't use an ESOP to provide liquidity, if it's a closely held company, you potentially have a problem, because I just got a bunch of shares in Joe's search engine, and it's really turned out well. They're worth a lot of money. And I have to pay a bunch of taxes on these shares because they're fully vested. They're not restricted anymore. And that's going to cost me money now, but I can't sell the shares. So the company needs to find ways to be liquid. Do we sell the company? That's what ends up the case in most cases. And do we make the vesting contingent on liquidity so that we don't end up in the situation of paying taxes prior to the award becoming liquid? Or do we have an internal market? Can employees buy from one another? It's possible to do this. It's complicated. Not many companies do. The company could buy back the shares. That's a non-deductible expense, though. Secondary investors may buy shares. We're seeing this more often now in companies that have good prospects for long-term growth. Sale to outside buyers is by far the most common way that liquidity comes up in these closely held companies. You just sell to another company. And everybody's dream to do an IPO, but that's kind of like a lot of teenagers thinking they'll grow up to be sports stars or rock stars. And the percentage of companies that achieve those goals is roughly the same as the teenagers who achieve those goals. So it happens, but not that often. So you might want to provide interim liquidity. These are some of the key resources that we have. The Decision Maker's Guide to Equity Compensation goes through all of this in much more detail, obviously. We have a book on limited liability companies and equity compensation. It's the only publication that does that. These are all, should be live links. We have a survey that's a bit dated now, but still, I think, somewhat useful. And then we have a book on staying private, which looks at all the liquidity options. And that's our website. And we have time. We're at the end, but I'm happy to stay for questions.
Okay, well, thank you, Corey, so much for this very informative presentation. If anybody has any questions, like Corey has mentioned, we'll hang out just for a few minutes. And if any questions come to you, maybe later on, you have my contact information. You can always email me, and I am happy to forward them to Corey. And Corey, thank you for always being so amenable to answer all our questions.
I would love to get questions, and people can just email me or go to our website.
Great, thank you. So this concludes today's webinar. As I mentioned earlier, a link to the archive version will be sent via email by the end of this week. If you have if you'd like more information on the Rutgers, New Jersey, New York Center for Employee Ownership, here is our contact information. And our web address is ownership.rutgers.edu. So thank you once again, Corey, and thanks everyone for participating. We hope you enjoyed it and hope to see you in our future webinars.
Thank you all very much.
Bye.
Bye.